I've been a licensed CPA for almost 3 years and have worked for some of the biggest organizations like Deloitte and some other Fortune 200 companies. Today I'm going to be reacting to TikTok tax advice. Let's dive right in.
Never show the IRS that I'm making any money.
Okay.
When you get your first job and you're making 200 grand, your goal is to get that 200 grand to 11,000 bucks.
How do you do that?
Your taxes on this is going to be 1,100.
Right.
I want to spend $189,000 on goods and services that could help me make more money next year because I'm never paying the IRS. Let's say I made 200 grand and I could keep 189,000. I'm going to take that and go buy a $400,000 piece of real estate that'll give me $189,000 depreciation, and now I only pay taxes on $11,000.
This advice actually doesn't apply to 99% of the people, and the math is wrong. Let's assume that he is describing someone who is a real estate professional. That means you're spending more than 50% of your time in real estate services and you spend more than 750 hours in real estate. This will allow you to take losses from real estate and apply to that 200,000 income. So how can you generate these losses? Through cost segregation and bonus depreciation. Let's take the 400,000 rental property as an example. You're only able to depreciate the building portion of your rental. So there is a land portion and there is a building portion. Usually the building portion is roughly about 80% of the total value. So out of a 400,000, you can only depreciate 320,000 over 27.5 years. If we apply the cost segregation study on this property, generally you are able to depreciate roughly 20 to 40% through bonus depreciation. So let's take the higher 40%. This means that 40% of 320,000 or 128,000 can be used towards bonus depreciation. In 2023, the bonus depreciation was 80%. So we would take that 128,000 that can be used towards bonus depreciation and multiply it by 80%, which gives us around 100,000 of depreciation in year one. So he will be able to generate roughly 100,000 deduction in year one, not the 190,000 he was talking about. In addition, in 2024, the bonus depreciation is now only 60%, so that will decrease it even more. Okay, let's move on to the next one.
3 tips to save money on your taxes in 2023. Elect to be treated as an S corporation. There's phenomenal tax savings there.
Just elect to be treated as an S corporation. We see this advice all over social media, but that's not always the case. That's true. S corporation can generate some tax savings. When you organize your business as an S corporation, you classify some of your income to be as a salary and some of the income will be as a distribution. You pay the self-employment tax on the salary, but you don't pay self-employment tax on the distribution. This is where the tax savings come in place. Once you're an S corporation, you have to file 941s, 940s, annual reports. You'll have to issue yourself a W-2, so you'll have a higher compliance cost. In addition, you need to take into consideration the state that you live in. For example, in California, you pay a 1.5% tax on net earnings or a minimum $800. This would not apply otherwise if you were just a self-employed individual. When you're an S corporation, your 199A deduction is also lower than if you were self-employed. This is simply because you take a deduction for wages that you pay yourself. So you also have to take that into consideration. Overall, S corporation could be a good way to save money on taxes, but you have to analyze it on a case-by-case situation. If you're making $20,000, $30,000, $40,000 from your business, it might not make sense to create an S corporation.
Tip number 2 is if you have children, be sure to hire your children in business to perform a legitimate business service and be able to shift your income to their tax bracket, which is essentially zero.
This is true. You can legally hire your kids to perform services in your business, but there is a lot involved to make sure you do it legitimately. First of all, you must pay reasonable wages given the job. You cannot pay $100 for stacking papers or $200 an hour for some simple data entry. In addition, entity choice is really important. If you're a sole proprietorship or partnership where each partner is a parent of a child, the payments are not subject to payroll taxes, but you must withhold income tax. If you are a corporation or a partnership where each partner is not a parent of a child, the payments for services will be subject to payroll taxes, income taxes, and FUTA taxes. In addition, you must actually pay your child. That means that you must transfer that money into a bank account that they have access to or their name appears on. You should also track all of their hours. You should have a notebook with a date, description, and all the duties that they've performed for that day. You'll need to file all the paperwork. You'll need to issue a W-2 for your child, and they'll also need to make sure they file a 1040 return. This adds an additional compliance cost. Lastly, you also need to make sure you're compliant with child labor laws. For example, a child under 16 cannot work more than 8 hours a day. So that's just something to keep in mind. So is the tax saving worth the hassle? It might be in some situation, for example, where you have multiple children, where you're in a high tax bracket, and where you have all the payroll already set up. But in some cases, it might not be. So it's important to analyze your specific scenario.
So guys, if you're looking for a write-off this year, you still have 60% bonus depreciation in 2024, which means that you can buy a car as long as it's 6,000 pounds or heavier, and you can write off 60% in year one. It doesn't matter if you pay cash for the car or if you put $5,000 down and make payments, or put $0 down and make payments. You still get to write off 60% in year one. Use this strategy to buy in the year that you did really well in, because next year may not be exactly the same.
Yes, you can actually do this, but it's important to clarify a few things. You need to take into consideration the business use. For example, if a vehicle costs $100,000 and you're only using it for 60% business use, you're able to apply that bonus depreciation only to the $60,000. In addition, buying that vehicle must be an ordinary and necessary expense for the business. For example, if your business is an accounting service, you are not really able to justify buying a $100,000 truck. Lastly, when you sell that vehicle, you will be responsible for depreciation recapture. So it's not necessarily that you just receive this one-time tax deduction that you'll never have to pay back. It's simply just a shift in timing.
Hey, Tax Tip Tuesday. Don't forget, gambling losses are a tax write-off. Every day for lunch, I come out, I pick up scratch tickets off the ground. You pick up an aluminum can, you get what, 5 cents? This right here, $2-3 a pop. I haven't paid taxes in years.
Wow. Assuming this video is not a troll post, you cannot actually do this. Gambling losses are only deductible up till gambling winnings. For example, if you have 5,000 of gambling losses and you have 0 in gambling winnings, you're not able to deduct that $5,000. In addition, in order to deduct gambling losses, you have to itemize your deduction. Currently, roughly 90% of Americans take the standard deduction, so that's just something to take into consideration as well. Overall, there is a lot of bad advice out there. Most of these posts just try to clickbait you without providing any additional context. If you enjoy watching this video, comment down below and hit the subscribe button so I can create more of these videos. I'm almost at 500 subscribers, so I'd really appreciate if you can subscribe.